All right, so today we are going to look at budgeting and control questions. And I've seen you've been posting some questions in the group. I hope I answered some of them, but I'm going to look at the group and see which other questions remain unanswered. But I've reset my phone, so probably just reshare them with me so that I am able to catch all of them. So we are going to look at this question statistical. So when you look at what is asked of us, they are saying prepare a rolling budget for static core. Then discuss the problems. Okay, and they want the rolling budget for the next 4 quarters. Then discuss the problems that have occurred at static core due to the previous budgeting process and the improvements that can now have been seen through the use of realistic rolling budgets. And then discuss the problems which may be encountered when static core tries to implement the new budgeting system. So everything about this question is about rolling budget. So first thing you need to know is what a rolling budget is. Because if you don't know what a rolling budget is, then you won't know how to prepare it. And basically, a rolling budget represents a budget whereby you don't have, it's usually opposed to a static budget, whereby for static budget, you set your budget at the beginning of the year, and that's it. You don't change that budget, and you just come back in the end of the year and look at how you performed with that budget. So that is the static budget. Then the rolling budget, on the other hand, you set a budget for 4 periods. Could be maybe you are using periods, which in this case quarters. And then at the end of this first quarter, you roll forward another quarter. So when you are here, you have all 4 quarters inside. Then when you reach the first quarter, then you utilize what you have got from the first quarter, and then you roll the budget to another quarter. So that at every one point, you are looking at 4 quarters. Then when you finish the second quarter, and you are here now, you roll another quarter. So you go to another 4 quarter period, like that. And the reason why it is better than the static budget, we shall discuss it later, but of course you can see the obvious advantage of the fact that by me rolling the budget, I am actually always looking at what has happened in my assumptions for the first period, and then utilizing that to basically come up with how to best improve for the next budget, the other quarters that are coming. So, of course, we shall look at the problems that the static budget has been causing, and then the issues that they'll have implementing this new budget. But at least now we have some idea what the question wants, so we can go and look at the material that is given or the scenario. So they're saying that Statico is a multinational consumer goods company, and it has used a fixed annual budget product lines. However, historically, if the product line would fail to reach the sales revenue at the end of the first 3 quarters, then the director and the finance director would go back and reduce the sales revenue for the quarter just ended to make it look like the target was reached. Okay, so this is very important. If the product fails to hit the target, then the company will just go and reduce the sales revenue target for the quarter just ended. So, for example, if target was 5,000 and they hit 4,000, they would go backwards and cross this one to 4,000, so that it looks like they have reached the target. Then they would get that extra 1,000, they put it on the second quarter. But if it was 3,000 there, they make it now 4,000. They keep going like that until, of course, the last period. So during the last financial year ended 30th August, the practice meant that managers had to heavily discount many of their products in the final quarter because now you have all the targets that were being pushed. Now they are in the final quarter and you have to account for them. So they have really had to do heavy discounting. And the reason why they did so was to make sure that they can be able to sell, to boost sales. So even with the discounts, however, they still did not actually reach the targets. And then on the basis of the sales targets set at the beginning of that year, company had also invested 6 million in a new production line in January 2016. However, the new production line has not been used up to now. As a result, start saw a dramatic fall in returns on investment from 16 to 8% in the year. So they have told you 2 reasons why the targets, the return on investment has reduced. One, there was a production line that they set up, but because they have supposed to have invested that, they invested the money, but they have not used that in this year. And also, the thing that they have been doing with the shifting goalposts. So those are things that you need to discuss when it comes to now the discussion part when they're asking you to do so. So consequently, the director, the MD and finance director and the sales director have all of this been dismissed. So now things have got sour. Those people have lost. They have been dismissed. Is not they have to see. Okay, what now? Now that they have been dismissed. So now they have been dismissed, and the 2 key members of the finance department are also on sick leave. So this is another problem. Some people are on sick leave. Remember, they said what is going to be the issue with us implementing this rolling budget. Whenever you're doing a new implementation, you need personnel there. But if they are not, that means that you are not going to be able to have enough staff to actually handle the transition. So that is one of the things that we may actually be looking at here. And we also have a new MD, and is inexperienced in the industry. And he's the one recruiting a new sales director and a new finance director. So a person who's not experienced is not going to make good choices per se. But in this case, he said that these mistakes could have been largely avoided if we had used the rolling budgets instead of manipulating fixed budgets. And this is correct. So, and then he says that from now on, we shall be using rolling budgets, updating the budgets on a quarterly basis with immediate effect. So the original fixed budget for the year is here, and the first quarter has just been ended. So now we have this is for all quarters, but the first quarter has already been ended, which means that we have actuals for this quarter. So what do we have? We have revenue, we have cost of sales, we have distribution costs and admin costs. So this is how they prepared the budget. They used these assumptions. The first one was that sales volume would grow by fixed compound percentage each quarter. So we need to determine what is that percentage that was anticipated. Gross profit margin would remain stable each quarter, and distribution costs would remain a fixed percentage of revenues each quarter, and admin cost would be fixed each quarter. Now, we need to use this. So we need to know how to now set up our rolling budget. So this is what we have been told about the budget and how they prepared it. But as I said, since the first quarter has already been done, we have information regarding that. And we can see from here that revenue was 14 million with costs of 8.7, and then distribution costs and admin costs. So we need to compare these with actually what was budgeted. But for now, let us continue reading. We shall do that. So the MD believes that the difference between the actual and the budget sales figures for Q1 is the result of incorrect forecasting of prices. However, they are confident that the 4 assumptions the fixed budget was based on were correct, and that the rolling budget should still be paired using these assumptions. So they're saying should still use those assumptions, preparing our rolling budget. So, but what we need to do is to now account for the fact that we have first quarter's data. So now we can go and start preparing our budget. Now, it can help very much if you are able to copy this information, but if you are not, then you have to figure something out. So, first of all, we need to look at these assumptions, because ideally what we are going to do is we are going to start with these actuals, okay? And then we are going to start using these actuals to prepare the budget. So what do we need for our rolling budget? So this is statistical. So we are going to prepare a rolling budget. So what do we need? Okay. So, and as we said, since quarter one is already done, we are going to roll and start from quarter two. So we need quarter two information, quarter three, quarter four, and then quarter one. So what you can do could be to say this is quarter 120x7. So therefore this is quarter two x7. You can actually put the whole thing so that we can at least be able to identify that this quarter one we are referring to here is for 20x8. So that is something that is important for us to distinguish. So what do we need to do? We need to have revenue, then cost of sales, and after that, so I can actually first set up the budget. So we can set up the formulas already so that when we put in our figures, we have our gross profit. From there, we can put distribution costs and administration costs. Then we have our operating profit. Okay, so that's what we have. Now, remember that if you look at what we had here, quarter one revenue was 13,425. Okay? But what has ended up happening is that the actual revenue is 14,096 for quarter one. But they said that one of the assumptions that we had was that the sales volume would grow by a fixed compound percentage each quarter. So what we are going to actually start from the sales, the actual sales of quarter one as they have come out. Then we shall now grow them by this percentage. But now what is this percentage? We need to determine it. So we need to, for us to determine that sales growth that was anticipated. So we need you see we have 14,247, then we have 13,425. So the way the growth was meant to be is that, because they're saying fixed compound percentage each quarter. So which means that from quarter one to quarter two, the growth was meant to be some percentage, then quarter two to quarter three, but same fixed percentage. So what it means is that we can determine as a working here, the growth in revenue. Now, there are two things that we can do, because for me, when I see compound, I think what we are doing is to say, okay, 14,247, 247 divided by 13,425. Now, because these are 4 quarters, there's been growth for 1, 2, 3 times. So if I say this one power third, I subtract 1, this is the growth. Okay, and that growth is 2%. That's the growth in revenue. And if you see what I've done, I have done what the question said, compound growth. So for you to move from quarter 1 to quarter 4, there has been a compound growth of 2% per quarter, which means that I can get the revenue of quarter 2 using the actuals of quarter 1, which is actually 14,096, 14,096, and I grow it by 2%. Okay, so let me just make this one fixed. That becomes 14,378, and actually I can now grow it for these other quarters, because ideally what I need is to grow the previous one by 2%. So 14,666, then you go and you finish it for the rest of the periods. So 14,959 and 15,258. So that is the revenue. And the other assumption that we had was that the gross profit would remain stable each quarter. So what was the gross margin? If you look at another working, gross margin. Now, of course, we are going to use the actuals so that we can determine the gross margin. So we are going to say, if this gross profit is 5,356, then you divide this one by 14,096. That should give you about 37% or 38% gross margin. So that means that the cost of sales basically are going to be 100, or 1 minus this gross margin. Okay, and let us fix it also in place. Multiply by our revenue. And the cost of sales are going to be minus, so we can put minus in front of that. And you have 8,915. Then when you drag through, then you get yourself your gross profits. Okay, so far is it okay?
Please repeat the second working.
The gross margin.
Yes.
The gross margin is usually gross profit divided by the revenue. So what we are going to do, because they told us that the gross margin is going to be stable each quarter, so we are going to use the actuals for the first quarter. So we get the gross profit 5,356 by the revenue of 14,096 to get the gross margin. Okay?
Okay.
Yeah. So then the other thing they told us was that the distribution costs would remain a fixed percentage of the revenue each quarter. So we can also still do the same thing, distribution costs. Again, we can use the actuals. So distribution for the first quarter turned out to be 705 divided by the revenue of 14096, which gives us about 5%. So that is the distribution cost. Now we are going to come here and say again 5%. So we can fix it. So 5% multiplied by the revenue. That gives us, oh, I changed the, okay, let me just change this one to I. Yeah, so which gives us 719. Then you drag them through, and then also the admin costs are going to be fixed each quarter, which means that for the admin costs, when you go to our admin costs, 2000, that's what was predicted. But then the actuals are saying 2020. So we are going to use 2020. So, and they are going to be fixed. So we drag them throughout the whole thing, and then we get ourselves the new rolling budget. And I think we are working in thousands. So that is also important to indicate that you're working in thousands. So that is how you work, you make a rolling budget. Now, why did we use actuals for revenue? And why did we use actuals for rolling? The reason why we did so is that the MD said, or he believes, okay, that the difference between the actual and the budgeted sales figures for quarter one is a result of incorrect forecasting of prices. So which means that for them, they are saying, we made some mistakes forecasting prices in quarter one, but the assumptions that we have made are the same, they are going to hold. Now, you should realize that that is an assumption also, so which means that, again, you can be allowed to say, okay, this is what they are saying, but me, I'm saying differently. What if actually the problem is not only on the forecasting, but also the assumptions? So you see, but of course, you can't now proceed with any calculation if you make that assumption, because you won't have how to roll the budget. So that's the first part. And you can see if you know what to do, it should be a very fast one, because you don't even have to put these workings here. You can put them straight in here. Okay, but it's also okay to put them here. What I'm telling you is that you need to learn how to be efficient when it comes to what do you choose to do regarding these issues. Okay, so second question is discussing the problems which occurred due to previous budgeting processes and improvements which we may start seeing. So now this question is directly asking you the problems of having a fixed budget. Okay, so now what are those problems? So the problems First of all, the inflexibility. The budget. Okay, because one of the things that you need to realize is that when you are doing budgeting, definitely you're not going to be as accurate, because what you are doing is basically coming up with assumptions that are going to help you construct what you think is going to be the futuristic price for that. So ideally, what that means is that you are not expected to be accurate. So if that's the case, you would need to have some kind of flexibility, such that in case you have new information that has come to your your attention, that can help you identify where you had made mistakes and allow you to correct it, then that would actually do what? Help you to adjust the budget. But in case of a fixed budget, that's not possible. And that's why you saw they are starting to do these things of saying, okay, budget is for the year, so let us start pushing everything to the final quarter. And that's where we start having all those problems that they mentioned. Also, the other problem that is very clear for this is that the wrong budget figures made Statico invest in, was it a plant or was it machinery?
It's a machine.
It was a machine.
Mm.
Yeah. So made them invest in a machine that they didn't use. Okay. So that creates inefficiency. So what may have happened was that, see, if you predict that you're going to sell 1,000 units, then you ask yourself, okay, but do I have enough for those 1,000 units? No. So perhaps I need to bring another machine to help me with that. So you bring the machine. But then the demand turns out to be very, very miserable, in that ideally you are not going to actually be able to do anything with that miserable budget of yours. So that means that what has ended up happening is that you have a budget, but it's not going to be beneficial because it has made you to invest when you shouldn't have invested. So that's a problem. Okay. So, and that 6 million that you incurred is going to really be a problem. So, but also when you budget, you normally also end up staffing based on, again, the budget. So like the poor budgeting would also trickle down. Poor staffing of the personnel. So if you think you're going to produce so much, then you might also need to bring in so many people to help you with that production. So that ends up costing you, because ideally you really didn't need those many people. So that is a challenge. Then another thing that we said was that poor budgeting led to massive discounting at the end, or in the fourth quarter, which led to loss of revenue. Okay, so because they wanted to sell the units that they had planned to sell, so they cut the price so that they can sell as many as they can. Of course, that means that you are selling at a lower price, so revenue was lost. So those are, and if I remember, you have to be looking at the question. So you don't want to write you don't have to write so many things when the question is for 6 marks, because we have already made 4 points, and yet we need to also talk about the improvements that this budget is going to bring. So probably we can now start the improvements. So now, of course, with improvements, you can always get them from the problems. So the rolling budget provides for flexibility where the assumptions used can be revised based on actuals for the first quarter. So imagine you had thought that you were going to sell so much, but then you sell less. So ideally that would indicate to you that, okay, I should not now plan to sell these many units at the end of the year, because if I have failed to sell what I had planned to sell for the quarter, what about when it comes to now the end of the financial year? So you of course now give up on that goal of yours in the first place. So that is the flexibility that the loan budget has given to you. So then the other thing that they can give you, because this is the purpose of the loan budget, but another thing is that you always have a budget for a full 4 quarters at any time. That's an advantage, because if you have the normal budget, so when you start your year, at the end of the first quarter, you now have 3 quarters to consider, then at the end of another. So you keep on reducing, then by the time you reach the fourth quarter, you don't have the budget for next year. But with the rolling budget, you always have a budget for the next the next 4 quarters, which is also important because it helps you to plan very well. So, okay, so that is what you can put there for that. And now the other part asks for the problems which we may encounter when we want to implement the new budgeting system. Now, what you need to realize is this question is not very generic like you saw. It is actually specific, because they are saying encountered when static core. So when you're answering, you should also say static core would face this issue, because if you don't do that, then examiner may feel like you didn't relate it, you just picked answers that fit anywhere. So the first thing is that the MD is new and inexperienced, so may have issues with implementing the rolling budget. Okay, and also the rolling budget needs more personnel and time than a fixed budget. And why do I bring this out? So I'm going to continue that statement, but what I want to bring to the attention of the examiner is that the key members of the accountant departments are on sick leave due to stress. So, and the accounts department is not well staffed, as key personnel are on sick leave, and we don't have a finance director and a sales director or sales manager, how they call them. Okay, they are calling them directors. So we don't have those people. So of course that means that we don't have enough personnel to pull off a rolling budget. So then what? The other issue is that information required to produce a rolling budget might not be easily accessible. as the previous F, D, and SD have been dismissed. Okay, although they usually say that information not dependent on one person, and therefore chances are what you need might be available and all, but it's always easier when the person who actually set up the system is the same person who you are trying to ask them provide information. But if that's not the case, then you find that what you need, you are not easily able to get it because people don't know where it is. So that is one thing that we need to consider. And that's the end of this question. I don't know if you have any questions regarding any of the attempted parts.
No, no, I don't.
Okay.
So you didn't bring out the point of the return on investment falling. I don't know if
the,
that's a big deal. Mm.
the return on investment falling. Okay, that was a consequence of the budget that we have been doing, the fixed budget. So now it could be explained here on that last point of leading to loss of revenue, but also the poor planning that made them spend this machine. Because return on investment is basically revenue divided by capital invested. And those 2 points explain it very well because revenue deteriorated because of the fact that they gave massive discounts, and also the capital invested increased because they invested in a new machine that they ended up not using. Okay, so you can explain it, you can make it a fifth point to combine these two, or you can explain it in the last one. Okay.
Okay. Mm.
All right. So I think we should take a short break of 5 so that we can start another question. So let's come at 55 past 4.
Okay.
Okay, so the next question we are going to do is also going to come from budgeting because budgeting has so many facets to it. So just by looking at these two questions, we have looked at a few of them, and you of course need to look at the other questions that are under there. So this one here is asking us to prepare a flexed budget. And again, you need to understand what we call a flexed budget before you can know actually how to prepare one. You can see it is for 3 marks, so probably they don't expect you to do so much as long as you know what to do, that is. And then you have to explain the main weaknesses in the current monthly budget statements that are being issued, and then discuss whether an incremental approach to budgeting is appropriate for Yumi. There's another thing called incremental budgeting. Then you also have to discuss that, and then define a participative approach to budgeting and explain the potential advantages and disadvantages of introducing this approach. So this question tries to bring several aspects of budgeting. First, starting with the fixed budget, which basically, when you are doing that, you have looked at the fixed budget, then you are looking at the flexible budget, and also the flexed budget. So you have looked at all of them if you look at the flexed budget, but then you have to also explain the weaknesses of what is being done right now. We don't know what they are doing, so we are going to look at the scenario and then discuss whether we can do incremental budgeting, which is another type of budgeting, and then, of course, participative approach to budgeting. So that's what the question requires us to do. So, of course, if we are now to go to the requirement or the scenario, So they're saying that Yumi has a number of restaurants. It is well established, and it has restaurants having favorable reputation for the quality of their meals. So the restaurants are all set in rural locations. Everything they tell you is important. So what is going to be the difference whether you are in the rural location or whether you are actually located in a place which is maybe a city? Is there going to be a difference? I don't know, but that's something that you may need to find out. Then, where there is limited competition. So this is the reason. Competition is limited, and therefore they have developed a loyal customer base. So when you have a loyal customer base, it is easier for you to predict demand, okay? Because you know you have this person, and this person coming to buy from you. So you can easily determine how much you're going to be needing. So they design their own menu and decor to fit the requirements of the local market. So Yumi has been consistently profitable. However, across the restaurant industry, there is a problem, and therefore the profit margins are quite low, and there's still constant need for Yumi to monitor costs. So motivation is that the margins are low, and therefore you need to monitor the costs so that you don't find yourself on the wrong side of the transaction. So one of Yumi's restaurants is in the small town of Kauli, and Kauli has recently been the location for the filming of a popular television series, and visitor numbers to the town have increased significantly as a result. Remember, we said we could predict our customer base, but here we can't, because in this small town, there has been a popular television series showing, and therefore there is so many people coming. So there has been an increase in customer numbers in Kauli. So at the start of the current month, a new restaurant opened in Kauli, so there's competition. So the manager of Yumi's restaurant in Kauli has expressed concerns about the impact of this competitor on their ability to achieve profit targets for the rest of the year. So that's something that has happened, may have an impact on the solution. So the budgets of all Yumi's restaurants are prepared by the head office. So now this is something that you need to think through as you are reading, because if these locations are in different areas and they have their own menus and they have their customer bases that are loyal to them, so why are they preparing the budgets from head office? Does head office have enough information regarding the people, the demands, those kinds of things? Do they have enough information to be able to cater for them? That's one thing that you should consider. So at the start of the year, the managers are given an annual budget, which is split into months. And at the end of each month, the manager receives a statement comparing actual monthly performance against budget. Another thing, remember, we are supposed to discuss problems regarding this. So if you break down the annual budget and split it into months, question is, are you splitting it equally? Because there are some months that are more busy than other months, and therefore, if you're going to be judging me on a monthly basis and you are splitting it equally, then perhaps you are not judging me to honestly. But that's something that you need to consider as you go. So, but these are the statements that they receive. So they would have the actual, the budget, and variance. So they are looking at customers, and the customers, for example, you see that the actual were more than the budget. So, of course, now that means that everything that follows down should not just be looked at as it is. Hence the need for flexing the budget. Because flexing budgets is done for different activity levels. If you plan, and I think this is a question you asked me before, if you plan for 1,500 customers and then you end up having 1,800 customers, then everything you have planned is going to be different from the actuals, because revenue depends on how many customers buy. It will have a difference, even if the selling price did not change. Cost of sales, the same thing. Okay, if you have these people, they will take less drinks and less food. You will pay fewer people for these people. Like, you see that everything will change as long as the activity changes. And therefore, it's not good for you to just start judging me that I have done poorly or I've done well based on the activity levels that were budgeted versus the actual ones. Hence the need for flexing. I hope that is clear, because you had asked me to explain it. And they are giving you some notes here to explain what is happening with these. So here what we need to know is, do we have some things that are fixed, then that are variable, and then maybe also semi-fixed or semi-variable. So they're saying that rent, rates, and other overheads are apportioned to its restaurants by Yumi head office based on a fixed annual charge. So which means that for these three things, doesn't matter the activity, okay, because they send you a fixed annual charge. So per restaurant, then all other costs are treated as variable costs based on expected number of customers, which is what you expect for the variable costs. So if we proceed, Yumi currently adopts an incremental approach to budgeting. So that is what they are already doing. So the question was asking us, what is the problem with what they are already doing? And you see how they are defining incremental budgeting. They start from the annual budget of the previous year. Okay, so one of the things that goes wrong there is what we call inefficiency. Inefficiency will be built through. If a person put in Slack last year, you just start from that and you add more units for this year. So it's usually not a good idea to do incremental budgeting. Of course, when you look at the notes, and also if you go to the study hub and you read through, you will see that there are some reasons why you shouldn't do incremental budgeting, but there are some cases where it is actually something that you would like to do. But the new director has joined the company, and they have questioned whether it is suitable for all Yumi's restaurants. So maybe they're saying that some restaurants is okay, but others maybe not so much. So he also suggests that the company should adopt a more participative approach to budgeting. Now, what is happening currently is what we call the top-down, whereby head office sends you the budget, you read through the budget, you start doing the budget without any input from your side. What they are asking for here is the bottom up, where each of the restaurants would come up with their budgets, and then they combine those budgets to form the one for head office. So, of course, now the question is, which one is better than the other? And that's what we are going to answer as one of those questions. So let us start by looking at how we are going to flex the budget. So to flex the budget, we need to first of all get the original budget. So this is Yumiko flexed budget. So we shall start, of course, with the original budget. The original budget had number of customers, which was 1,800. and then it now had the revenues. So we had
customers are 1.5.
Sorry, 1.5. Thank you. So now we have the revenues. So our revenue was 75,000. Then costs, we have food and drink. Food and drink was 22,500. Then we have staff wages. Staff wages is 31,500. Then heat, light, and power. And that is 7,500. Then we have rent, rates, and other overheads. That one, they said it is 12,000. And then profit, which is basically the revenue minus the sum of these costs. Which is 1,500. Then, so that's the original budget. Now, as we said, we can't compare this original budget with the actuals because the actuals have an activity of 1,800. So we need to first of all flex the budget. So we are going to create a flexed budget. And the flexed budget is flexed for the actual activity, which is 1,800. Now, of course, they said that the only thing that is fixed is rent rates and other overheads. So which means that those ones, we can just copy them here, no problem. Okay, that is the flexed budget because they are fixed, but everything else is determinant, is treated as variable, which means that for it to be variable, I'm going to say this is 75,000. So this is for 1,500. So if I divide by 1,500 and I multiply by 1,800, that now becomes 90,000. So that's what it means here is that although we had budgeted for 75,000 as the revenue, but because the actual people that have happened are more than 1,500, they are 1,800, the revenue should not be 75, should be 90,000 as per the budget, which is flexed. So it makes sense for you to now compare this flexed budget with the actual, okay? Because now you are now comparing with the similar activity levels. And the actual one was 87,300. And here now you can say that this person performed poorly. Because before, they had said that this person performed actually better. You see, because they were comparing 1,500 people to 1,800 people. So that's the reason why we are flexing the budget. Then we can now have the variance. And the variance is going to be, so now for the revenues, we compare the actual and the flexed. So if I subtract actual minus the flexed, I get 2,700, and this is adverse, okay? And what you need to realize is that the sign can indicate adverse if you say so, but it's always good for you to put adverse, because the sign depends on what you separated first. I could have separated this one minus this, or this one minus this, and I get a different sign. But now, what you put here tells you whether it is adverse or favorable. So now this is what we are going to do for the rest of the costs. So what I'm going to do is to fix these things so that they don't move. That's why this is for 3 marks, because ideally what I'm going to do is copy this and paste it here. And I have all the figures. Then I can now also drag this and you put it here. Now for the costs, what I'm going to do is to start by bring the actual food and drink, 26,100, staff wages 38,250, then heat, light and power 8,100, then rent and rates 12,600. So now for the variance, I am going to start with the flexed minus the actual. So why I'm doing it that way, this is now my sign conversion, because if I have spent more than what was the actual flexed budget, then I have done poorly. But if I've spent less than the actual flexed budget, then I have done well. So this is favorable. Then I can drag this one down, and you can see that this one is adverse, this is favorable, and this one here is also adverse. Now, as for the profit, you can see that I was supposed to, when I flexed, have a profit of 4,200, but I'm having 2,250. Okay, therefore, when I compare now, but I think for these ones, let's make sure we have not made a mistake. No, but the variance is going to be what I should have got. Well, I mean the actual profit minus the flexed profit. So I have a variance of 1,950 and it's adverse. So now I can say, okay, this whatever this one is, I think this was for the for the query. So this performed poorly. Okay, it was 1,950 adverse. And where was the problem? The revenue was low, lower than expected. Staff wages higher than expected, and the rent rate and other overheads higher than expected. Okay, is that fine?
Yes, yes, it is.
Okay. So now this question happened to have only that one as the calculation part. The rest, which is 17 marks, is for discussing. So theory. So make sure that you are clear with your budgeting theory. Because if that question like this came and you only know how to do this, you are not going to pass that paper or that question specifically. You can pass the paper, but not the question. So part B is asking us, or we actually part 2 of part A is asking us to get the weaknesses of the current budget statements. So weaknesses of current budget statements. And I think the first one that you can see from here is that we are calculating variances without taking care of the difference or the activity levels, the difference in activity levels regarding the budget and actuals. Okay, that's the first weakness, because it means that basically you want to reward someone for something that they didn't really put as much effort themselves. So we are not flexing the original budget. So now, the other thing, if you look at what the budget statement is saying, it said every cost was adverse. Okay, so the cost statement also says that all the costs were adverse, or there was an overspend without taking into consideration that the customers served increased from 1,500 budgeted to 1,800. So all of the points we are going to give are going to be rotating around that, because ideally that's the problem that this budget thing has. Okay, so now, because of the fact that you have not accounted for that increase, it seems as if you have performed poorly in all aspects of cost. And yet, after we have flexed, you can see that we have only performed poorly in wages and rent, rate, and other overheads. Okay, so that is the second issue that you have with that budget, or that budget book. Now, the other thing is that we have assumed that staff wages are variable, heat, light, and power are variable. So, assumed that staff wages, heat, light, and power are completely variable. Yet, in actual sense, most of them will have a fixed component, and thus better regarded as semi-variable costs. So now, an example I can give you, staff wages. You always have to have some people that you cannot live without. So, like for example, maybe 20 employees. Then those 20 employees are always there. And then the only time you change those numbers is if you, for example, get some casual workers to help, because you have maybe, like for example, in this case, increased customers. And you can actually try to explain that, you see here, we performed poorly in the staff wages, even after considering that the customers we are serving increased, which means that we spent more. And the reason why that is the case probably is that, you see, when you have to get people mobilized very fast, you don't pay them the same money as you pay your normal employees. If you're paying people $200 per hour to do something, then if you need people very fast, probably the only incentive that you can give is that if you are able to either pay overtime to the people who you already have, which will still increase the costs, or if you're not paying overtime, you get people to come and do the work. And those people that you bring to do the work, chances are they are not going to be earning 200. They will earn more than 200 because you need them on short notice, and therefore you need to incentivize them so that they can come. So that's the reason why you find that we may have performed poorly on staff. And also rent rates and other overheads are fixed, but because probably there is a celebrity in town, maybe they are filming this series that, like they said, the people who actually rent out these things decided that the cost should increase. So that you may find that can also be an explanation as why he performed poorly. The problem here is that they're not asking us to explain, but they are just looking at the fact that we are considering these things to be completely variable is a mistake, because they normally have that aspect of being semi-variable, whereby they have a fixed component and then they have also the component which is variable. So that is one problem. And you can also use the same explanation and say, as well, rent, rates, and other overheads may not actually be completely fixed and may have this. There's something called a stepped nature. An example you can give here, stepped costs like warehousing. So warehousing, when you have one unit to keep in that warehouse, you pay $20,000. But even when you have 500 units, you pay $20,000. The only time that warehousing costs change is if the warehouse you have now has filled up and you need an extra warehouse. So the cost looks like it's fixed for a long time, but then after some time, after some activity level, it steps up to another cost. So considering that you are saying that they are just fixed may not be realistic, because imagine if what we had was able to account for 1,500 people, but now that we have more, probably we need to rent some small space to have those people come in, and other things can happen that may increase those costs. So they are not completely fixed. They can be semi-variable, but also they can be stepped. And I hope whatever I'm talking about here is not new to you. If it is, please utilize the textbook or utilize the study hub so that you are able to catch up on some of those terms: stepped, semi-variable, fixed, variable costs, the different types of costs that we can have. Okay, are we still together?
Yes, we are. We're together.
Okay. So that is part A. Then when you go to part B, it's asking to discuss whether an incremental budget is appropriate for Yumi. Now, as I said, for you to answer this question, you need to first of all know what incremental budget is, which fortunately the question explained to us that they get last year's budget and they flex, they change it. They probably can add 2% on everything, something, but they just increment from the previous budget. So it has advantages, it has disadvantages. So you can give those, then you discuss, okay? So when you're discussing, basically you're saying whether it is appropriate for Yumi or not. Okay, so that's the last part that you should give. So if I were you, I would give 2 points here, 2 points here, and then this is where I bring it out, bring it home. So, of course, advantages of incremental budgeting, it is very fast. Okay, because of course, you don't have to start afresh. The opposite of incremental budgeting you can think of as zero-based budgeting, where every time you are going to be doing a budget, you start from scratch. You start afresh. You basically you have to justify each and every element of your budget afresh, like you didn't incur it before. So it is usually done like that because ideally what you are trying to do is to justify every expense every year. So it is better because it removes that slack. You don't just give people money because you gave it to them last year. You have to ask them, okay, why do you need to do this year? Then they explain. Then if the explanation cuts it, then they are added to the budget. As opposed to just saying, last year I gave you 2,000, now this year I'm going to give you 2,100. Without first of all figuring out, did they finish the budget for last year? Did they even do anything with it? How did they spend it? That kind of stuff. So that is the zero-based budgeting part. But this is very fast. You just increment it, that's it. Then also, it requires less work, less work and the personnel. So if you are having a company which is very short on staff, this would be a good way of utilizing that one person who does all the accounting of the company by not letting them have to make so crazy a budget. At least you can have them just start from the one they did last year and they just keep on changing in case this year maybe activity levels are different or not. But also in the same vein, because it has less work and less personnel, it is suitable for less changing environments. So like if environments are, if the requirements of the budget change a lot, like for example, if the projects that are being done are completely new from the ones of last year, then of course you can't do rolling, you can't do incremental budgeting because activities are different. So now, of course, for you to answer this question in the satisfactory sense of the examiner, you need to link the scenario. So now, as we said, we want it to be it is relatively easy. Okay, it is fast and it can be utilized where we have not so much things changing. Now, because we said that Yumi's hotels are found in locations that are rural without so much competition, so those are relatively stable environments. You don't find the customer base changing so much. You don't find that happening a lot. So that means that that is a little bit stable. So we can start from last year's budget and we just say, okay, this year we may have a slight increment of this, then you increase it. So that's the point here we are trying to bring up, is that since the Yumi's restaurants are found in the village where there's relatively low, where there's no competition and the customer base is loyal, you're going to find that nothing changes year on year that much. So that is one thing. But also, you have a relatively stable customer base, like I just said. So even if you don't know whether the customers are going to stay the same or one or two people are going to leave, or you really can have a small assumption that can help you change your budget. But now, you see, the problem with this budgeting approach, the disadvantage, it is what I talked about when we are starting, inefficiencies. Inefficiencies are kept. Now, because we are looking at cost control, remember they said that Yamco, even if it has been profitable over the years, because the margins are usually small, it has to control the costs. So if you are looking at cost control, then a rolling or an incremental budget is not so good because it kind of encourages, first of all, the slack that was kept in the previous budget or the inefficiencies to be carried forward. Because what happens is that you say, okay, last year we spent 2,000, so this year we may spend 2,100. So that's what you would do. Yet, in actual sense, if you check and you say, okay, last year we spent 2,000, but did we really need to spend 2,000? Then you start looking at it, and then you say, okay, how can we save? And that is basically what is done in zero-based budgeting. So having budget which is incremental may not give you that reduction in costs that you so desperately need. And therefore, it may be more pertinent that Yumi uses, for example, zero-based budgeting, because that is what will help them control costs. And also, what else? Then you can also say it may not be stable for this location that we are, that location of Kauli, at least in this time, because of the fact that now the customer base has substantially changed. Okay, and the reason why it has substantially changed is because of those people who have come for filming that TV series. So definitely that's not going to be appropriate. Okay. I don't know if that is clear. We go to the last part.
Please repeat that last one. Why
Yes.
it won't be appropriate.
Yes. Now for this location in Kauli, because there are many people who have come in that they are filming that TV series, so the customer base has changed. But not only that, there has also been a competitor which has opened up in that same location. So you see all the things that we talked about that we need to happen: stability of the business operations, low competition. All those things are not true anymore for the Kauli restaurant, and therefore having incremental budgeting may not be so appropriate for that location. Okay.
Okay.
Yeah. Okay. So now we go to the third part, and the third part is basically discussing the participative approach. Okay, and they're saying first of all, define what is participative approach and explain the potential advantages and disadvantages of introducing this approach. Now, one thing you need to remember when you are doing these questions is that you have to answer all the parts that are given to you in a question. Now, this question has 3 parts. You have to define this approach, and then you give advantages and disadvantages of having that approach for Yumi. If you don't give all the 3 perspectives, you're going to not get all the marks that you could have got. So first, what normally happens in that, the best thing is to just have these sections broken down, define, then advantages and disadvantages, so that you know when you're answering that I've defined, I have given some advantages, I've given some disadvantages. Therefore, I have handled the entire question. That's what you should do, not only for this question, but for all questions where there is theory, or even the ones that are calculative, so that you make sure that you have looked at all the different facets of the part, because you may just look at perspective approach and you start writing everything you know about it without actually answering the question. So how do you define participative approach? So this is an approach whereby, in a business, there are operational heads, then you have the tactical heads, then you have the board. Okay, but that is usually for a company which may not have such businesses like we have here for Yumi. So you need to answer it based on how Yumi is doing it. So in the perspective approach, here you'd say that each restaurant manager would prepare a budget and send it to headquarters. Okay, that is what you'd find with the participative approach. Because what you are trying to emphasize there is that there is participation from the budget holders, as opposed to the top-down approach whereby the head office makes a budget and sends it down for you to execute. So by having those budgets done from the different restaurants and sent to headquarters, what is going to benefit? So then you start advantages. So the advantages of having participative budget is that the budget holders have more knowledge of their market, but also logistics, customer base, all those aspects of their business. So they have better knowledge of their business, and they are better able to forecast revenues, expenses, and those other aspects than a person who's seated at headquarters who doesn't even know where the village is, and they're just using some Excel to allocate sales that have to be made by the different managers. So by the fact that they each know better, they will make better plans and they will make better forecasts. So that is the first thing. So they understand the environment very well. They understand the constraints that they have. And an example you can give here is that if they were not doing the top down, the manager for Kauli would have probably known that there is a filming that's going to take place in their location. And therefore they would have known that that's going to increase the customer numbers, and probably needed to have more staff recruited earlier on so that we don't have to pay overtime or even get them at a very expensive rate. That would have helped with the variances that we saw. So you see that is coming up because you are now linking the scenario, which is very important. Now, another advantage that you can have is that when you are involved in a budget, you take ownership. Have you ever been given a task and they say you have to sell 5,000 units of this, but then you feel like it's all a cure because it's not, you don't feel that you are adding any value to yourself. They gave you numbers, you have to execute. But if they had sat you down and they discuss, they tell you why we need to first sell those units in the first place. Then they ask you, what do you think is the best alternative? What of the best approach to doing this? And they have an inquiry with you. Probably by the time you start selling them, now you know why you have to do it and what benefits. So basically you put in all your effort. And that's better than giving you a target which you didn't have any control over. So that is the advantage, or the two advantages that we have put. Then the problems, of course, it's going to be time consuming. So imagine you tell all the different restaurants to set their budgets and send them to headquarters. Then the person at head office has to compile everything. Then now that has to be discussed with the heads, maybe even the board. Then they have to agree on it. Then you have to send it back to the different restaurants. Then they have to sign on them. So there's so much time that is spent. As opposed to you, when you send the budget down and you say, all right, this is what you have to do, start doing. So it's faster that way. But of course, it's not better. So that is one of the problems. The other problem is that we shall have influence from managers. So if managers are allowed to set their budgets and send it upwards, they may actually only put what they think they can achieve and not have that incentive to work harder. So they may confuse, or they may actually basically manipulate the budgeting process to suit their needs, which is not something that you want to happen, because that means they will probably not be looking at cost cutting the way you want it to be, and basically you'd end up in a situation which you didn't want to happen. So there's that. Okay. So also managers would look at things that would probably reduce their targets. So for example, they will tell you, for example, the person of Kauri may not tell you that there's a film incoming and it's going to increase revenue. They may just tell you, okay, this season is going to be difficult, so give us lower targets, something. So ideally, not having, you know what we call goal congruence. The company as a whole has a goal to achieve, but then each manager is trying to have as less work as possible, which may end up having those people choose targets that are lower than what they ought to have been able to achieve if you had forced it on them. So there's always that problem. So those are some of the disadvantages that you can actually put here, as well as the advantages. And of course, you can easily go to the solution and you pick out more and see how they have explained to them. So I don't know if you have any questions for now.
I noticed you defined participative approach to budgeting relating to the scenario. So for me,
Yes.
I had quickly gone to like define it in the theory way, the way that I know it. So would that be the case like for questions, even when they say define, you shouldn't go away from the scenario, but even just mere defining should be based on the scenario.
Okay. So now, when you are defining, you can do both for you to make sure that you are not moving away from the scenario. Because what you might end up doing is define without looking at the scenario, which is what probably you have thought about. So what you can do is to define it purely theoretically, and then tag a line there that relates it to the scenario. That is going to be better than defining it without linking to the scenario. So that's why I prefer to define in the context. So because the question just said, if we are to go back to what they are saying, they're saying define participative approach to budgeting. Okay, so in fact, if you define it on a theoretical approach, you get the mark in this case. The only thing that you would do not give you marks is if you're explaining the advantages and disadvantages theoretically, like you have them in the book. So because that is the one that is linking it to Yumi. So to avoid having that kind of problem, what I used to do when I was doing these papers is to always think that every time I'm answering a question, I have to link everything to the scenario back. It saves you from having to forget to do so. But for this first part, it's okay the way you have defined it.
Okay.
Okay? Yeah.
Yes.
So any more questions?
Just to take you back to the previous one of the incremental. So,
Yes.
um, like while we conclude, because they're asking us to discuss whether or not, yeah, incremental approaches to budgeting is appropriate. So, what would
Mm.
that conclusion sound like? I know we had pointed out from the scenario about the new competitor coming, but like just help me like phrase what that would look like.
Okay.
I know, yeah.
So In this case, you would say, based on the advantages of incremental budgeting and disadvantages, the disadvantages outweigh the advantages, especially that Yumi is trying to cut down the costs. So therefore, it would not be appropriate for Yumiko. However, given that they have quite stable customer base, except for in Kauri, you could apply it in those other places, but for Kauri, you do maybe zero-based budgeting. So they normally don't penalize you on the conclusion based on if you have concluded this way or the other way. The point is that you have to give an opinion. That's what they want you to do based on what you have put. So you could actually have said that based on the advantages of meta budgeting, it should, and given that Yumi has a very stable customer base for most of its locations, it is appropriate. Or you can say, based on Yumiko's goal to reduce costs, it is not appropriate because it is going to encourage inefficiencies to be carried forward. And either of those two would be correct. Okay?
Okay.
Yeah. All right. So I guess if there's no more questions, we shall stop here and see you tomorrow. I think same time.
Yes, I just need clarity on a question I was doing, but I'm going to post it in the group.
Okay.
Mm.
Thank you very much. See you tomorrow.
Thank you.